couple of you guys coming in. So we're just giving it about a minute or so before we get started. Okay, it looks like we have enough people. I'm gonna just start the session now. So welcome to our fourth event. We are the Middle East chapter of Carnegie Mellon Tech and Entrepreneurship. I'm Sanjeet Srivastava. I graduated from the Pittsburgh campus in 2003 with degrees in information systems and computer science. I run my family-held firm, Rock Met's Trading and Distribution Division out of Dubai in the UAE, where I'm based right now. I also head this Middle East chapter of Carnegie Mellon Technology and Entrepreneurship, which I'm going to abbreviate to Carnegie Mellon, so CMU TNE. For those of you who are new to CMU TNE, these are various global chapters designed to get alumni to get together, build trust capital via events like this, Slack channels, etc. So we can help each other find jobs, hire each other, learn from each other, and hopefully form startups together. Today's event will be in a webinar format, so you won't be able to see the other attendees, but post the event, there will be a quick networking session in the regular Zoom format where you'll be able to interact, stuff like that. I will be posting that on our Slack channel and on and broadcasting it as a message on the Zoom as well. This event is being chaired by Yamna Naveed Khan, who has just come on board and heads our professional engagement. Over to you, Yamna.
Hi, everyone. My name's Yamna, and I graduated from CMU in 2013 from CIT. And basically, I had my own startup in employee benefits, and I'm now running the transformation and innovation at CETA, which is an aviation company in the IT sector. And so today, what we're going to be talking about basically is fundraising, and specifically fundraising in the region, how different it is, how similar it is to other regions, and we're just going to be talking to two founders who have raised from investors in the region. So I'd like to welcome Haris Aghadi from Meddy, as well as Sanjeet Sahni from Ogma Learning and Magna Ventures. So if you guys want to come in and just do a little bit of an introduction about yourself, we can start with Haris.
Hi, everybody. My name is Haris. I'm the co-founder and CEO of Meddy. So I initially graduated from CMU Qatar campus from 2014. I studied information systems with a minor in business. So Meddy was a class project at Carnegie Mellon that later was spin off as a startup, and we've been running it for almost 4 or 5 years now. We're the largest doctor booking product in Qatar and UAE with about 150 to 200,000 monthly active users. We're growing pretty drastically, and our aim is to be the largest doctor booking product in the entire GCC. So yeah, happy to answer your questions on fundraising. This is something we have struggled and painfully experienced for the last few years. So happy to share all the learnings and help other people hopefully raise more money.
Awesome. Thank you so much, Haris. Sanjeet, if you want to introduce yourself.
Yeah, hi, everybody. Hope everyone's doing well and keeping safe at this time. Graduated Carnegie Mellon 2017, so a little later than everybody here, I think. But yeah, since then, I also had a bit of a school project, similar story to Haris, where I started my startup, Ogma Learning, in my penultimate semester of my senior year, and then it just rolled on from there. I'm no longer at that startup. I exited about a year or so later, and now I'm with my own family business here. We're in real estate and hospitality, and just running a few more independent projects too, which is what Magna Ventures is.
Congrats on the exit.
Thank you, yeah.
Awesome. Okay. So I just want to, like, you guys are in like very specific industries like medical and education. What was like, how did you guys actually think, or how did it come about to start in those industries instead of something that's more like e-commerce, consumer focused, which is very common in the Middle East?
Sanjeet, do you want to go ahead?
Okay, I'll start. So essentially for me, it was an e-learning platform, which Ogma Learning was a part of, and essentially it rolled out in a way where I wanted to do an independent study in my last semester of senior year. but we had other ideas. My main reason to get into the space of e-learning primarily was of employers helping employees train them better. And I think from my own experience is what really, the idea sprung from. I've done about maybe 5 or so internships / projects, apprenticeships, whatever you want to call it. And what I felt that there's always this one person trainee assigned to you, and they help you, navigate whatever you want to learn. But my own need to learn and absorb everything that I was doing and during that experience wanted me to, to push myself and create a project like that. And like I said, I wanted it to be an independent project, but we got lucky. I would say that it was a fortuitous path, and it just rolled on from there. So really, my own experience and helping employees when they come in and get better experience from employers to train themselves is what really got me in.
That's okay. That's awesome. Haris, what about you?
Yeah, well, in our case, I think it was more of a personal problem. So I think in 2014, I think we had a class project called Tech Startup Launchpad. It was a course about startups and how you do lean startup methodology and do that. So I mean, part of the project was, you need to come up with an idea, form a team, refine, do business, do customer development, and actually launch a product out there. So I think in that, when we were discussing like what ideas to come with, I mean, we were not that excited about, it wasn't like a very methodical discussion on, oh, should we do consumer product or should we do B2B finance or fintech or anything like that? It was like, okay, what are the problems that we do face on a day-to-day basis that we think can be done better, right? So one thing that always came up was like health. Like one thing we realized is like, I was born and raised in Doha, and all the team members were also pretty much born and raised in Doha. And one thing that always came up with that is that in any social gathering, people are always asking for doctor recommendations, right? You go to any doctor, they're like, hey, do you know good dentist? Oh, do you know good pediatrician? Oh, my dentist I was going to this dentist for the last 3 years and now he left the country and I need to find another one. I have a tooth filling and whatnot, right? This is always this question that came coming up. And we coming from technology background always have this bias is like, okay, that sounds like a pretty simple problem to solve. Why not just create a website and put doctor's product and make booking? Little did we know that was like one of the most toughest challenging problem to ever solve. And then there's like an ongoing learning for the last 4 or 5 years around that. But that's how we got the idea. It was more of a personal pain point, right? So when any social gathering, people were always asking for a doctor recommendation. And that's how we got started about that.
Okay. That's a very interesting thing. But so in your journey so far, what have you guys actually like found to be like the biggest problem building these startups? Or within your industry, kind of digitizing the industry, so as to speak?
Yeah, so I can talk about from healthcare perspective. So one of the biggest challenges in healthcare is like digitizing. So healthcare has always been a laggard when it comes to adopting technology. And the reason behind that is like one thing you want to think about is that doctors and physicians, they are trained to mitigate risk, right? So they're not that people who are going to be like, if you look at the product innovation curve, right? Healthcare is always the laggard, the last thing. They're never going to be the innovators. They're never going to be the early majority. They're not going to even be the late majority. They're always going to be the laggard. They want to see if everything has been tested, tried, proven, and then only they can adapt it, right? Because they're so afraid of risk, because in their case, risk is death or some malpractice or getting sued by this. So they're very, very afraid of trying out new technologies or new product, anything like that. So it was always been a challenge to get adoption from the provider side, from the healthcare side. Like one of our biggest challenges right now is like actually integrating with their calendar systems. And those are legacy-based software, a lot of bureaucratic issues, and just like, they're just not comfortable crossing that barrier and actually being comfortable integrating with us, right? So that's something we've been always struggling, and we keep getting more and more integration, but it's much, much slower than you would expect, right? So there's always been a challenge. So healthcare will always, despite you have so much investment, if you look at the actually GDP per spend in healthcare, or actually the technology spend in healthcare, there's like a crazy amount of money being spent in healthcare, but still you don't get that adoption from the consumer side because they're just so risk averse. It's a very long sales cycles. It's very bureaucratic, a lot of policy makers, a lot of decision makers. So things are just incredibly slow when you're doing with healthcare. So, and also the other issue is like you also have compliance, you also have regulatory issues when it comes to healthcare. So a lot of things just kind of slow you down from that aspect, and there's not much you can do about it. Just patient and just constantly just trying to cross that barrier.
Okay. And so just we can delve a little bit deeper into that and kind of go towards maybe like talk a little bit about like, so you guys started off like, how was your MVP? at what point did you feel like, okay, fine, like to go or dig a little deeper into like your fundraising journey? At what point did you feel like, okay, fine, now we've got enough of a product that we can actually start raising funds, and obviously like at that point expand or like go deeper into product development?
Right. So I think in our case, the good thing that we did is like, so Meddy was kind of part of like two different classes. The first class was the tech startup launchpad, where our entire purpose was come up with an idea, refine it, go talk to people, and actually figure out that this is what you want to do. And then there was another class that I did was the senior project, where we actually build the product. So in the first phase of the class, what we did is like, we were talking to a lot of people, and the best thing about that class was that you were forced to go get outside of CMU and actually talk to customers, which was a very scary thing to do, because, you know, you're always this comfortable building in the academia and you're living in this bubble and you're building crazy new technologies or learning about AI and ML and all the crazy tech. But then when you go outside the university and talk to people, the way they react, the way they answer the question is very different, right? So the first thing we did is like, we went and talked to a lot of hospitals. We talked to people on the streets. We went to cafes and tried to understand, how do they find doctors? What are the struggles that they have? How do they deal with health insurance? Like, what kind of information do they get from their employers when they come to the country and whatnot? So those were good insights that kind of helped us figure out like, these are the possible distribution channels. And then when it came to MVP, the first thing we did is like, we created like a Photoshop hack and put it on a static website and actually told patients like, hey, these are the top 3 doctors. And technically they were not even doctors. It was random Google images with fake reviews that we showed to people just to get that idea, like, how do they think, right? We went super lean, super dirty on it, because that's the entire purpose of MVP. I think this is one big misconception that a lot of people have, is like, they think like, oh, I need to go raise my angel round to build the MVP and hire engineers and then actually launch a product. No, you're getting the entire concept of MVP wrong. The purpose of MVP is to validate your most riskiest assumption, right? And you will be surprised how less amount of effort is required to actually building an MVP. Like, if I were to do Meddy all over again, my MVP would be a WhatsApp group or a Facebook group, right? That's how I would validate if it works or not actually building a product. I would not touch code for at least a year or even more than that before I even do any product development from that aspect. There's so many now low-code products that are out there, so many things that you can do with just prototyping that you can stay away from building. Because and this is another issue that happens when you come from a tech background. When you're doing like something like IS or CS, you do some sort of product management, your mindset is already thinking of features in your head. You're already thinking of flows. You're already thinking of writing codes and everything, right? And you have to get away from that mindset very quickly. You need to go away like, that's not how your users think. Your users have much more primitive problems than you think, right? So it's very difficult to get outside of that tech bias that you have and start thinking from an empathy and start talking to users in a better way.
Yeah. No, and Sanjeet, what about you? Like, I know, like, for example, like you kind of went ahead with a similar thing where you guys were building your MVP, which was very simple. And once you build it, I believe, is when you reached out to an investor.
Yeah, true. I mean, the path was pretty atypical, if I'm being honest with you. So essentially, yeah, we just had this idea that we wanted to make this module of helping like create onboarding and training packages for employees to get better access to whatever they want to learn across their tenure, even if it's training or beyond that time. But yeah, I'd say the MVP was pretty simple, to be honest with you. It was just like some sort of an interface, and here, you know what, somebody record a video and just plug it in. How do I do something? And then somebody plays it. Oh, okay, this is what we do. So very simplistic, and I completely echo the sentiments that Haris has. Just get started, get the ball rolling, and once you get a little bit of customer validation, you get in this feedback loop that allows you to improve yourself, improve your product, and then just then go on for potential fundraising. But I think even having a little bit of an MVP allows you to go and speak to investors then, because if you're having some validity, you can have something to say. And that helped me, even though it just happened through networking that I, managed to raise the funds. But, it was very, very atypical path in that sense, but completely echo Haris's sentiments when it's like, be easy and just start.
So what have you found about, like, for example, like how investors in the region think? Because I found, like, personally, as per my experience, I found investors in the region going like, okay, not just like your MVP, but show us how many customers you have. What is your revenue? At that early stage where we're talking about MVPs that are so basic, and then investors come up with like a whole bunch, and these are like super early stage, so like angel investors and stuff. what have you found has been like in your experience the feedback that you've gotten from investors at what point they think you should start raising funds? Is it as early as the basic MVP that we're talking about?
Well, I'll be the first to say again, my journey was atypical, and I will have to admit that yes, I got fortunate. Essentially, what happened, I mean, we were at in the middle of the semester, so the winter break, and I'd come back to Kuwait. I used to live in Kuwait before, and we were at a party. We met somebody, and I'm telling him that hey, I'm working on this thing. They're like, oh, how exciting! I know someone within a family office that's interested, to have a product like this. Of course, like we were still at very, very primitive stages, but this is what they wanted. And then he said, all right, let me just introduce you to them. And, we just had an introduction in like a week before returning to campus. And they said, all right, we like it and we can help you with whatever we want. So it was a very, very simple process for me. But that being said, I think people should take it with a grain of salt. It's not as easy as people think it is, but it's also not as hard as people think it is. You should just start and be focused in your approach. You should know what you want. And I really like the fact that you mentioned, you need to know what you're looking for. If you're just thinking VCs are going to fund me or whatever, and you're still not even at a stage where you're getting in revenue or you're getting in customers or some sort of, progress in your startup, you're not looking at the right kind of people that, will help you with the fundraising. You need to look at people like angel investors or people who are willing to put in the seed money. Family offices, in my case, really help me, although typically they do come in at a later stage of fundraising. But I think, they will have a conversation with you. It's very easy for them to say no, and they'll tell you you're not ready in the reference to your last part of the question. But yeah, I mean, just go get the ball rolling, but know who you're talking to, have that clarity in your mind in terms of what you want.
Fair. Haris, what is your opinion on that one?
Yeah, I mean, Sanjeet's story sounds pretty amazing, right? I mean, I wish we had that path. So ours was extremely brutally painful. So let me explain you how naive we were back in the day, right? So before, when we were launching the product in like July or August of 2014 or 15, I can't remember. And we were like, you know what, we'll get our first meet. We'll raise like an angel round like 4 or 5 months from now, and then a year after that, we can raise our Series A round. It took us 6 months to get a first proper angel meeting, right? That was our first meeting. And then it took that angel about 3.5 months to give us a proper answer that he won't be investing, right? So yeah, so my point is like that's how brutal the process was, right? Of course, we're talking to all the other people and everything. But my point is like, it also depends on a lot of externalities, right? So I was in Doha, and this is back in the day when you did not have incubators, you did not have QSTP properly set up, or ICT Qatar or QBIG and whatnot. They were just barely starting up. You did not have any funds. I mean, you still don't have any funds, but they were not a proper angel network as you have right now, at least starting to form, or startup ecosystem. Like there was barely anything back in the day in Qatar, right? We were just like, and the point is like we struggled so many challenges, from raising funding to setting up a company there to incorporation, finding the right partner, and the regulatory issues and whatnot. But fundraising was a very, very difficult for us. Like it took us about 2 years, I think, for bootstrapping that we actually got our first ticket. And even that ticket was incredibly small. That gave us maybe like 2-3 months of runway. So we kept raising more and more every few months. So we were like always like constantly in fundraising mode. Like, so one thing I actually want to tell people about that is that if you look at like these YC guides or a lot of these stuff from TechCrunch and whatnot, they have this thing like, you know what, you need to go in a fundraising mode, and they have like 6 weeks back-to-back investor meetings, and you line them up and everything. That doesn't happen in this part of the world, right? So people need to get their reality straight. It's like, you just don't have that many investors. Investors are not going to respect your time from that angle. You're going to just drag it out. So if you're raising your first round, it's going to take a very, very long time. And you should not be talking to a VC for your first round because you're just too early for that, right? You should be talking to angels. And in my case also, the one thing that I always tell people is like, people are too hung up on type of investors. In the early days, it doesn't really matter that much. And my point is like, yes, it's difficult to find angel investors because you don't have that many groups. But one thing I recommend a lot of people is that you should not be looking at proper angel investors. You should be looking at, one thing that I would say is like, look at executives at these big companies who are willing to put that ticket sizes in you. Because when you're starting up, you need like $10,000 to $20,000 to get started, right? You can find, if you are, and one thing as a startup founder is like, you need to be very resourceful on how you network. And if you can't find 5 or 6 of those people to actually just network your way through it and get some funding, then you're going to struggle a lot more finding down the line bigger customers and enterprise customers. So in the early days, my biggest recommendation to people is that if you're, let's say, working in, I don't know, construction, go talk to these big companies like EMR or so many other ones out there and find some executives that you like. And they're very likely to be able to put that ticket in you. And more importantly, they can add so much value in your company, because in the early days, you don't know how to set up a board. You don't know how to set up a sales structure. You don't know how to have a compensation structure in your company, how to hire people, how to find the right kind of candidate and everything. They can add so much value, because in the early days, there is a lot more important things than just money. I mean, yes, money is going to help you build product development and everything, but the advisory and the guidance that you need is like almost invaluable. So finding people from the same industry that you're in who can really add a whole lot of value towards it.
Yeah, I'd just like to add something to that. I mean, in the region too now, of course, like with what Haris is saying is 100% correct. Your industry, where you're trying to make the startup in your own industry, people who are willing to write that first check will be the most passionate about, because they'd want that industry to grow too. So you should really, again, like have that mindset of I want to be clear with what I want and what's the best approach to get that money. But also a trend that I've been seeing recently in the MENA region specifically is that they're now starting to understand that, hey, startup investing is good. It's going to get big, and we should, get our hands dirty in it. There's a lot of competitions happening too. If you want your early money, come in. I mean, we had, even in Doha, I think we had I don't know if QSTP had competitions or so, but they did have, some type of, people come in and they're willing to, impart you with some money. Saudi Arabia is very big on it. MISC, they're having like up to $1 million in prize money with the competition that you get in. So these are, fantastic avenues for you to raise that initial money. And then, then you go on and develop your product further, which opens avenues to, different types of investors.
I think that's very interesting, because I do know there are a lot of hackathons and a lot of startup competitions that offer cash prizes. So that's definitely a good avenue. I've been holding on to a question for Haris. I wanted to know, you said your first investor or you're not so much of an investor. The first person you reached out to took 3.5 months to say no. What was the feedback they gave? Because I feel like that's where feedback's very important.
Yeah, so I think I want to get back on one thing that Sanjeet said is it's very easy to say no, but this is not something I have experienced, right? My point is in the early days, if an investor tells you no, I would be thanking them, because that means you don't have to spend your energy in chasing them. The biggest problem that you see from VCs or these big incubators or even angels is that they never say no, right? They just, because if you think about it from an investor perspective, they have two things that are always in their mind. One thing is something that looks good but ends up being a crappy company, or something that looks bad but ends up being an Instagram, right? Those are the two fears that they live on, right? So my point is if they look at a company like in early stages and they don't like you, it's very easy for them to not give you feedback, because 6-7 months down the line, you might become very attractive and they can always come back in, right? So they don't want to close that bridge completely off and saying you're bad from that perspective. But some investors are extremely good. You have some really good investors that are unicorns that come and tell you hey, you're too early. But if you work on this XYZ things and come back to me in 3-6 months and validate these issues that we think we have with your business, then come back and talk to us. For instance, right? I mean, we raised our Series A round late last year. We had investors in them that I was talking to in 2015. It took them 4 years to come and invest in Meddy, because I've been constantly being in touch with them for all these years and giving them quarterly or semi-annual updates, telling them what the company is up to and having these casual meetings with them. Because one thing you also want to understand, I mean, there's a really good post by Mark Suster from, I think he has a blog called Both Sides of the Table. He's an LA-based investor. And he says investor invests in lines, not dots. So when you actually pitch to an investor, he just has one data point about you. You just launched a product, you have X in revenue. I want to see you in 3 months, how does that dot grow? How does that know? And my point is once you meet an angel investor for the first time, you probably want to tell them what are your next milestones? And you want to come back to them and tell them I did hit my milestones, right? And I'm going to keep doing this again. And that's how you build that validation. Investment is not you meet someone and tomorrow they're going to write you a check or they're going to say, that just doesn't happen. Investment is not a transactional relationship, right? It takes a long time for you to build up that relationship for them to feel very comfortable investing in you.
Yeah, I think that's actually very interesting. I think a lot of times startup founders are just okay, fine, an investor said no, or they're not responding, and then that's it. I think the part where you mentioned about building a relationship, I think that is definitely something a lot more startup founders should be focused on, for sure. Yeah. So you just said that you mentioned that you raised Series A last year. Congratulations.
Thank you.
How different was that from your seed, for example?
Yeah, so that's the thing, right? My point is like, I always want to tell, we never had like proper rounds, right? My point is like up to Series A, we had raised money like 6 or 7 times by then. Because one thing I want to understand is like, we went through a very, very painful fundraising process.
Mm-hmm.
Probably most companies have not gone through that. So I've seen the very ugly side of things from that angle, right? I mean, most companies usually have is like, you know, they launch a product by their own money for the next 6-7 months, and they go raise like 100, 200K round, seed money, and then they get into an accelerator, and then they raise a Series A round. Ours was somewhat similar, but our ticket sizes were so small that we always constantly had to be fundraising. Now, answering your question, yeah, I mean, Series A was different because that's when we got like proper institutional money. We had big family offices coming in. We had 2 big VCs coming in internationally. And the good thing is like in that Series A, we also had people from the previous round who did their follow-on investment because they liked the progress that they made, that they wanted to double down on their investment and exercise their pro rata rights. Right. So that's also a pretty good validation that you want to see. Like some of the companies that you see is that they don't have their existing investors investing in their next rounds. That sends a bad signal to the new investors because it kind of seems like if the existing investors are not investing in the new round, it's something might be a little bit wrong. So you always want to, so what I'm trying to say is that once you get the money from an investor, the relationship doesn't end. You still want to get, my point is, your investors always have a lot more money to invest in you. That one ticket size is not the only thing. They will probably invest even more if you actually can build that relationship, show that progress, show that traction, they can invest in you. So our Series A took a very long time. I mean, I was reading the Magna report. I think the average in the region is about 7-8 months. Ours took probably a little bit more than a year. But that's when, you know, properly Series A raising, like talking to institutional investors and actually getting that. I mean, there's a lot more nuance to it because it also depends on your legal structure. The due diligence could take a very long time. Finding a lead investor is probably the biggest challenge that most companies are going to face when they're raising a prize round. But yeah, it was a very interesting experience, very difficult, very painful. But I wouldn't say it is massively different from the previous rounds. It's more structured. If you have more traction, it becomes easier.
Okay, fair enough. And now you just mentioned family offices, and I know Sanjeet, obviously you got your investment through family offices. How do you guys think? So personally, for example, like I've seen that family offices are a huge proponent of investment in the region, which is very different from other regions, right? I'll throw it over to you, Sanjeet. What have you found as family offices? Like, what have you found the difference, or how do you categorize family offices as compared to traditional investors, which are your VCs and stuff? Because they've got the same amount of money. It's just, I would imagine they would have a different investment style. And how is it to approach them and, you know, kind of get that investment from them?
Probably they have more money. I mean, this part of the world, we have a lot of money. So, you know, generally speaking, I think that the trend has changed over the past few years, especially the past couple of years. More family offices are becoming more consolidated in their investment philosophy, and they're willing to take risks on especially tech startups. And this was not the case. I mean, I really sympathize with Haris. Like 4 or 5 years ago, there was probably nothing in Qatar, you know. But now they're starting to understand and, you know, get into this space. I think a key difference is that normally they come in at later stages than you know, a typical investor. So maybe they get in Series A, B, and, you know, so on and so forth. Again, my case was atypical, so please everybody take it with a grain of salt. My understanding from dealing with family offices, and now also we're also trying to become a family office ourselves, and my own family business, is that we're not necessarily looking for you know, time frames. Like, you know, most of the VCs have fixed contracts, and, you know, they want to be in for a certain time because, you know, they want to keep maintaining the deal flow and keep moving in and out, of course making the money. But I think family offices are more patient. They think more long term, and your approach to them should be in essence to be a partner, because they open doors for you, especially in this part of the world with everything running on Wasta and things like that. They can open doors for you that maybe a typical VC even can't. And it really helps to have them on board, especially now that they're interested to invest in tech startups in the region.
Yeah.
I just want to add to that. I mean, 100%. I mean, one thing you guys also want to understand is like family offices are probably the biggest LPs in the VC funds here in the region. Right. So one thing is that family offices usually don't tend to invest in startups, but they indirectly invest in startups through investing in a VC fund. right? So family office for sure, couldn't agree with more on Sanjeev that, they have a whole lot of money. They are probably the biggest source of capital. And for not just VCs, we're talking about PEs and hedge funds and everything from that angle, right? Family offices is a big source of capital. They are the big contributor to the GDPs of the entire GCC region, right? Every VC in the region has probably like 60-70% of their commitments coming from big family offices in the region, right? So yes, family offices, as Sanjeet said, and the good thing about family offices is that as compared to a VC, VCs usually have this very typical mandate. They invest in these spaces, in these geographies, because, they're taking money from so many different people. They have to build up like a thesis-driven philosophy that, it's a 10-year mandatory cycle. For the first 4 or 5 years, they're going to invest and then follow on, and they have to exit. So it's like a proper, strict textbook stuff that they have to follow. Whereas a family office, they are more opportunistic. Like they can invest in things that they like. They don't usually have a very strict investment philosophy. They have, and they don't even have any limitations on ticket sizes. You can have family offices investing anywhere from 50K to 50 million if you want to do that, right? So my point is like, it's all over the place. And one thing is for sure, the family offices are a massive, massive basta player. Like they can really open up doors for you that you couldn't get through anything else, because they know, the point is like big family offices, just think about, right, how are family offices built? Because they were running their own businesses back in the day. They ran that for decades and decades, and they became super wealthy. So that means they have the connections in the industries, right? Like, for instance, we got investment from a family office who used to run the biggest healthcare group in UAE, right? Which is a very big thing for us because it opens up doors to go to these different hospitals. More importantly, these family offices builds credibility for you when you're fundraising and you're talking to these big customers, right? So when I go talk to our big hospital groups and tell them like, this family office invested in us and they used to run this X hospital, you immediately build credibility, right? So my point is like, that is very important, building credibility, especially if you're in a B2B space and you're doing an enterprise sales kind of software. Credibility is pretty much everything, right? It's not really the price, because you can talk to these big enterprise customers. They tend to have budgets. They just don't have they're more concerned about the trust and the validity of the product itself, right? So these family offices can really open up doors and get you in the right foot and get you to meet the right executive in the company. So your sales cycles really gets down to the right person, because one thing, like for instance, most startups are going to struggle with their long sales cycles. If you're selling an enterprise software, you're talking about 6 to 9 months of enterprise sales cycles. But if you have a proper family office can open up the door, you're meeting the right executive and your sales cycle went from 9 months to 1 month, right? So it makes a lot of difference from that angle. So family office is for sure a non-obvious source of capital that a lot of people should be looking at. And yes, and you're never too early for that. If you talk to a family office and they say you're early, fantastic. You can always go back to them later on. One thing that you can, rarely a family officer will tell you that you're too big for us, right? But a VC will tell you that. You will go to a VCs and tell you like, oh, we cannot write that big ticket sizes for you because we don't have the mandate for that. But that is not a thing for a family offices. If they like you, they will write the ticket sizes.
Yeah, just last thing. I mean, this is very, very common for this region too. So this is, keeping in mind the MENA region too, especially the GCC. People should think more of family offices as, a potential ways of fundraising.
So like you guys all both mentioned Vasta and getting to the right network. Have you guys found them to be more hands-on than traditional investors?
Do you mean the family offices?
Yeah.
Yeah, absolutely. They want you to succeed. So they will open doors for you. They will help you. They will try to understand what you need, and why not? They're in it for the long term. So your success is their success in many ways. So they are very, very Vasta intense. Absolutely.
That's actually a very interesting observation, because coming from like someone who's not had experience with the family office, I would say it was my understanding or my assumption was that it was going to be more money rather than kind of having a hands-on approach. So I think that's a very great way of fundraising where you get the network and the investment.
I think it is, but again, like no two investors are the same. So it really depends on, who you're speaking to and whether they have that sort of approach of they want to be involved with you. And it's not like all the time they're in it. And some of them even work with, they become like a multi-family office. So like an MFO, and there's an SFO, which is a single family office by itself, investing in companies. Some of them, that makes them more, indifferent towards it. They just want to get returns. But some of them, especially the single family offices, they're committed to, I'd say, helping you grow too.
Okay.
I think it also depends on the skin in the game, right? But it depends on like how much of an investment they're actually putting in, right? So my point is like, if your ticket sizes are too small, and I think it all depends on how you use your investors rather than thinking about are they hands-on or not, right? Your investor could be really hands-on, but you really don't need their help. Like just because someone can help doesn't mean they can actually help you from that angle, right? So it all depends on how you utilize your investors properly, right? I mean, we have some investors that haven't helped us operationally, but we're pretty happy with the way they are, and some are really hands-on. So it all depends on how you utilize your investors. So I wouldn't look at it like, are they hands-on or not? Every investor, no one is going to say that they're not hands-on, right? I mean, why would they say like, I mean, every investor is going to come and say like, oh, we're very hands-on. I mean, yeah, why wouldn't you be, right? I mean, you want to help the company grow, so it makes sense for you to do that. But I wouldn't use that as a thing to validate or to assess if I want to take the money from that. The question is like, can they really add that value towards you, right? So answering Yamna, your initial question, like how do I see investors? I mean, one big thing that, I mean, it's kind of like a downside in some ways is that most VCs in the region are not operators compared to in the Silicon Valley or in the Bay Area, right? But by that I mean is like most VCs in that part of the world, they were either founders themselves in their previous life, or they were like early employees at early stage companies and they grew and they actually saw the success. So they can really give you these hands-on advice and learning a founder would need. Whereas most VCs in this part of the world come from PE and finance background. I mean, I'm not trying to offend that. It's just, it's a different mindset. So they're very good at building structure in your company. So if you get a VC at a Series A and B level, they can really help you formalize your company and how to scale up operations properly, how to hire the right executives and everything. Those are amazing advices that a company needs. But that is very different from the advice a startup needs when they are a 3-people company trying to find product market fit, trying to scale up for the operations, or trying to monetize their first customer. That's a very different kind of advice that most VCs cannot give because they haven't been in those shoes yet, right? So my point is that that's a mindset that people need to, and that's where having hands-on angel investors, having executives at these big companies to come and advise you makes a whole lot of difference.
Generally having advisors too, like advisors who are not necessarily putting in the money, but just, want to sit with you, they can sit on your board or whatever you want to call it if you're a 3-person company. But, that advice also is priceless. If people genuinely want to help you.
Have you guys had advisors for your companies? That's actually pretty interesting because I think that's one of the biggest areas that people or startup founders should be looking at. You get a lot of help from them. So like, what has your experience been with advisors?
So
I
we have,
did, but
so go ahead, Sanjeet.
No, go ahead. I said I didn't have because my entire journey was with a family office. So I think you're probably more equipped for this.
Yeah, so I think one thing that we did is like we try to get domain experts in everything, right? So I mean, one thing you want to understand is like none of the team members, we were coming from healthcare background, right? So we quickly had to find an advisor who was from healthcare, who was an executive at a hospital. So we're trying to get advice from them. Similarly, we got someone who was expert at marketing, someone who was expert at operations, and we try to always work with them. And now we have 3-4 advisors who are on our cap table who are not investing money in the company, but we have given them equity because we spend time to try to get their expert advice on things. And that's something I highly recommend everyone getting, especially getting a domain expert from your industry would be really good. I mean, it's the same thing, right? If you're trying to raise, like the advice that I suggested is like, if you're trying to raise money from an executive and they probably, let's say they don't want to invest, but they will be happy to advise you. And some of these people don't even want equity in the company. They just want to help you because they want to be part of something that they can grow with, right? So so there's so many people that you can try to get advice on. So that is, I highly recommend, startups should get like a domain experts in something. So if you are running a startup, get someone who has done marketing at a company in a similar sector, or someone who has done operations in that similar sector, or customer support in that matter, right? Those things are very, very critical in the early days.
Yeah, no, I think I had advisors for my startup too, so I'm completely on board with that one. I do think it's also like I said, it's a missed opportunity that a lot of people don't utilize enough of, but you could really use your advisors. And the same way I think a family office can help you, I think advisors can help you with networking and getting your wasta. So I think that's great. I'm going to jump a little bit on a tangent before we go on to question and answer. So we're going to talk a little bit about COVID-19. You guys were in obviously ed tech and, healthcare. I just wanted to know a little bit about how that's impacted. I know Meddy has come up with a new product. Congratulations.
Thank you.
I think that's great. I think that's a really great thing to be able to think on your feet and actually build a product during this time. Seeing where the need is and kind of adapting to that. if you guys are, because you guys are part of the startup ecosystem over here, what have you figured, or like what have you understood over the last few months that's happened? As for investment, I know investment has not decreased. In fact, it's increased, but it is fewer deals, you know. We've also gotten a lot of outside investment. So I believe 30% of investment is from from investors outside of the region. So it's really good to see our ecosystem grow. But what have you seen as what will happen with the after effects of COVID within your industry, for example?
All right, so I'll take a stab at it. So from a fundraising point, I mean, fortunately, we're not fundraising, and I wish all the best to all the people who are thinking of fundraising in this climate. It's going to be very difficult. So for sure, investment activity should go up, fewer deals, but more quality deals. So one thing for sure should happen is like every VC is going to pull out their checkbooks right now because asset prices are down across the board. So valuations have gone down. So why wouldn't you go buy? You're buying everything for cheap. Like one thing you want to understand, all the companies that we're seeing IPOs now, like Airbnb or about to IPO, Stripe and everything, they were all built in the last recession, which was in 2007, 8, 9. So most investors have made an absolute killing on their investments that they did back in the day. The return multiples are just like astronomical. So my point is like, this is another black swan event that we're looking at. I mean, are we going into a recession? Are we in a recession? It's debatable, but I think a lot of amazing companies will be founded in the next few months, and they're going to go amazing stuff in the next 10, 12 years from now on. So fundraising, I don't think it's going to slow down. I think probably what's going to happen is like investors are going to become more picky and going to start looking at business models who are more, like can actually withstand the COVID impact, right? I think that's what they're going to be looking at. So that's going to become a new criteria for them to assess business models, if they can withstand the COVID impact or not, or they're getting the tailwind from that or not. Within Meddy and healthcare, I mean, for sure, we were not immune to the impact of COVID. We were, absolutely impacted as well, because we saw clinics and hospitals got shut down towards late March and entire April. They started opening in June. So yeah, our revenues and bookings, all our core metrics were decimated in that period. But I'm pretty proud of the aspect that me and my team, we were actually build up an entire telemedicine product from scratch within 2 weeks. Wow. And we actually launched an entire enterprise product for hospitals and health and clinics to like just transform their entire practice into a virtual clinic, like pretty much overnight. So anything from managing patient records, billings, online payments, prescriptions were all managed through that. So that was a pretty good impact for us. And we saw that hospitals were using that for, follow up with their patients and prescription refills. So it's a good thing that we were able to do. Now, of course, telemedicine is something is getting a lot of tailwinds. Now, it's still yet to see in our industry if it's going to continue, especially the fact that now hospitals have opened up. So we have seen a drop in telemedicine bookings that are happening, but we're seeing our regular business model spiking up again and going back to almost pre-COVID levels. So I don't know, the jury's still out on how it's going to happen, at least in healthcare. But healthcare itself was impacted. Now, the post-COVID effects, it's still yet to see. I think we're still seeing different behaviors in Qatar and UAE. In UAE, it's more gloomy. It's more, I think UAEs always get affected. I mean, it's a very spiky market. You see, if there's the good things are happening, you see like amazing stuff, and that is happening, you see a very adverse impact, a more severe impact. So right now we're seeing a bit of downsizing in healthcare. We're seeing hospitals slashing down their marketing budgets. They're being more conservative on how they want to work with products and services. So that's what we're seeing in healthcare, but we're still optimistic about the entire space itself. It's going to rebound. It's not based on consumer spending. I mean, it is consumer spending, but it's not based on luxury items. So we're still optimistic about the healthcare space.
Yeah, generally speaking, I think absolutely. I think we even came across a stat where the first half this year has now had more money raised in this part of the region than the entire of last year combined. So that's a very promising sign. Investors are probably getting more picky because they're looking for factors like, is the business robust? What is the sort of adaptability that we have? And I think, Meddy's a shining example really in terms of how you guys have adapted, and telemed's going to be pretty big. So yeah, it's a great space to be in for you guys, but also for the investors. I think the money is going to grow, and we're going to see a lot of new, nice, robust companies coming soon, hopefully.
Yeah, perfect. Thank you so much, guys. So what I'm going to do is we're actually going to do a little bit of a question and answer over the next 15-20 minutes. We've had a lot of questions from before and during the panel discussion. So if you guys want to, what I'll do is I'll start with a few. And a lot of these questions, by the way, for our audience were resources based. So what we'll do is we'll actually questions that were resources based, like what is the list of investors in the region? How do you build a pitch deck? Things like that. We'll actually put up the resources on our Slack channel so everyone can get access to them. And over here, we'll just ask questions that would be very, well, that would Haris and Sanjeet can add a lot of value to, right? So I'm going to start off with one question that's related to advisors, which is because we spoke about them a lot, and then we spoke I think one of you mentioned that advisors don't always want equity, but a lot of times they do. And I'll take Haris, if you want to take this because you have advisors, how do you structure equity for them?
Yes, I just want to correct. Yes, I just want to correct a bit of that. I don't think they want equity. I think the reason I insist on giving equity is because I want them to be incentivized to be in the company and have the skin in the game, right? Because a lot of people is like, yeah, I have like 10 different advisors, and they talk to that person maybe once a quarter or once a year, and they're like casually doing that. What we do is like, we have advisors who are kind of like part-time employees in the company who are actually working with us and doing the legwork and actually being part of that. So that is very important for us. Now, how do we structure that? It's usually common stock. I mean, what we see is like the common practice is that you should have anywhere from 10 to 20% of your shares given to early employees and advisors. So we give a very small percentage of that to advisors, and we do that based on how many hours they want to spend with us in a month or a week. And based on that, we kind of structure it around. So there's like, I mean, I don't have a range because it all depends on the size of your company, the valuation you are at, the stage you are at, and what kind of person you're coming in, right? But I would say like it's very valuable to give that equity to an advisor that you think can add a lot of value, right? Because they can help you prevent mistakes because they've done that, they've gone through that stuff, right? I mean, in the early days, if you're building operations, is a very tricky thing. How do you hire the right kind of people? Like, I mean, from our experience, our biggest challenge in the early days was like hiring our first salesperson. I didn't do sales. My co-founder did not do sales. We didn't know anything about sales, right? Yes, we did sales back end, but we did not know how to hire the right kind of person, what kind of skills to assess. Yes, you can read a lot of guides and, a lot of articles online, but there is an advice that the advisor can add. He's like, yeah, look at this CV, look at that CV. And they can help you screen the candidates. They can even help you interview. Like, we have used our advisors to interview candidates that we wanted to hire, and we still do that. Right. So that is a very important aspect. So it all depends on how you want to utilize your advisor. So structuring them, it's based on common equity, right? So yeah, I mean, I don't want to give out ranges because I don't think there is any typical range. It all depends on the size of your company.
Yeah. So just to answer this audience member's question, I had an advisor at my company as well. And I think the way that I personally actually did it was just to kind of figure out what their time was worth. And then kind of go from there. I think that's a very simplistic way of doing it. But if you're at a very, very early stage, that might be one of the ways that you want to look into. Okay. So if we want to move on to the next question. Okay, so this is one which I think is very interesting because it's talking about developing your product. So product development and then market expansion. And what it wants to figure out, the audience member wants to figure out is they're trying to figure out when you're talking to investors, right? I think they're both very important, but which one at what point should you value one over the other? And I think it's a little bit of a tricky situation because obviously it depends at what stage you're at. But at what point do you go like, okay, this is the money we need, for example, marketing and stuff like that, and then this is the money where we need for product development, more of that. At what percentages do you guys go for?
I think from one end,
go ahead, Sanjeet.
And their goal is to improve the product. Oh, you want to go for it? Oh,
let me go ahead.
Okay. No, I mean, my pretty general understanding from the question was that their goal is to improve the product, and then they're wondering whether they should go for raise money for development or for market expansion. Is that right?
Yeah.
Yeah. So I mean, they've kind of answered the question. If you wanna improve the product, then you should improve the product. But then again, it depends on what stage you are at. It's a very personal thing. It depends from company to company. So is your goal to improve the product so you can raise more money? Then you can do that. But if you're depends where you are. Like, are you burned out? If you don't have any cash, then you probably should raise money. So it's a very, very, I think a personal company. Depends on every company.
Yeah, I don't have any different thoughts on that. I think it's very dependent on the company and this sector. I think what I would do is like, I would take the lean startup approach and trying to figure out what is it that you're trying to prove, right? So if you look at a different step in the first stage, when you're building the product, once you have the product, what have you validated so far? Do you have early traction? Do you have enough people using your product? Do you have enough retention? Is your retention curve flattening out that you really want to see that? And based on that, you need to decide that, okay, do I need to invest more in product development? Would that help achieve my core metrics or not? And based on that, you need to decide whether product development is the right way to go or market expansion is the right way to go, because it all depends on what you're building, right? So if you're building a food tech product, it's a classic marketplace product. There is not much R&D investment that needs to happen. It's more of a marketing and sales game, right? So it's like you just need to buy eyeballs for that. So that's more of a market scale expansion. But whereas if you're building something in deep tech, in something with like I don't know, AI or ML aspect to it, maybe product and IP towards it is very important. So maybe you do need more money to invest in product development so you can validate that. So again, as Sanjeet said, it's very, very dependent on your business, your key metrics and everything. But one framework that I always have in mind that you need to think about is like, in the early days, set up a key metric that you can use to gauge your company, like how good or bad it is. And then make your decisions based on that. Then think about like, okay, if I invest in product development, will that improve my core metrics or not? And if the answer is not hell yes, then you should really reconsider that.
Okay. Okay, to follow up with that, because you mentioned specifically that if you're doing it in like deep tech, we have another question in which it's basically like, if you're inexperienced or if you don't have as much experience, or you're not very much from an industry. So I'll take your example, like you guys weren't from the healthcare industry. How easy, how hard was it to convince investors that this is an industry that you know about? That sort of thing. What was your take on that?
Yeah, we were just a bunch of dumb college kids trying to raise money, and that's how we were perceived by most investors. And I don't blame them, because that's how we look like, right? I think the only way you want to change your mind is by traction, right? You can always prove any investor wrong by showing amazing customer data, right? So my point is like, it's not a game of sales or persuasion or how you can convince them. I don't think there is any convincing. I think if you want to fundraise, have amazing metrics. If you're concerned about, you're not from industry, we didn't come from healthcare. I didn't even have a job. If you think about it, I started Meddy out of a undergrad class project, and I've been doing that thing. So I don't even have any industry experience, let alone healthcare experience, right? So my point is like, I did not have any credibility even talking to hospitals or investors. But the way you prove it wrong is like, you talk to your customers, you get validation, you start building up traffic on your product, and you show that. So then it becomes completely irrelevant, like how good or bad we are, which industry experience we are, because we're not from healthcare, and we're still not. I mean, majority of the team, I mean, not all, I mean, probably all of them, we don't come from healthcare backgrounds at all, right? We're just coming from regular backgrounds, from marketing and operations and sales and finance and regular stuff, but no one comes from any healthcare background. And I don't think this affected us in any way, right? Sure, having a bit of healthcare background in the early days would have gotten us better deals or helped us sign up customers a little bit early on, but I don't think it makes a big impact. I think this idea of being a domain expert in the early on is a bit overrated. If you can complement that by having the right advisors and work really hard and get customer validation, right? So work on getting customer validation rather than thinking, how do I convince investors that do I look good or bad because I'm not a domain expert, right? Just focus on building a product and get more users. It probably will solve all your problems.
Yeah, I completely agree, honestly. I mean, I think, it is probably a little overrated. Not entirely irrelevant. Like, you can address it with the points that Haris has mentioned. I mean, if you have an advisor that has some sort of domain expertise, you bring them on board, that, just that tag itself gives you credibility that unless if you don't have anything. So of course it helps. But I mean, numbers speak for themselves. If you're doing well, you have the traction coming in, why will they not invest? It's for their benefit too. So put yourself in their shoes, If you're getting the numbers, then it's in the right way. So you can just keep on adding from there.
And just look at the prior companies, right? Look at Stripe founders, like they were college kids. They did not come from fintech background, and now they have changed the face of online payments across the world. Look at hospitality, look at Airbnb. I mean, you have so many startups, like majority of the YC founders or most of these big companies that you're seeing right now, they did not come from any domain backgrounds. I think what it is, like, they came from a fresh perspective. They were obsessed with solving the problem. They started thinking from first principles on how, or just disrupting the industry status quo, right? I think that's the way people should be thinking about it. And have advisors. I mean, I think that's something I would recommend. Of course, in some industries, you need a domain. I wouldn't say need, but having that domain expertise kind of gives you that edge and can help you fundraise a lot more quickly, right? But I think in most industries, you really don't need that, right? Like it's just, again, it all depends on what kind of industry you are targeting. Yeah.
Okay. And just to go, so we're going to go on a question that's a little bit at the start of the fundraising, which is what are your tips for networking to investors? So I'm going to start with Sanjeet because yours was purely based on networking, right? So what are your tips? And I mean, it was great luck, but obviously at the end of the day, it was through a network and it was through networking that you got there, right? So what are your tips to maybe not just network, but also get access to these investors? Like what is the first thing you would say, like this is how you can approach investors, or these are the few things, for example, through, I don't know, LinkedIn or, you know, different things?
Well, like first and foremost, I mean, networking and fundraising at the moment still is a people's game. When we had GPT-3 come in, so AI might take over soon, but still it's a people's game. And at the end of the day, you have to connect with people. If you are fortunate to have connections with people, then you can, like, you know, ask your network, hey, you know, tell people what you're doing. You know, don't be afraid of, you know, oh, my idea is not ready yet. It's, you know, I want to ripen it up a little bit more. Just go out there and talk to people who you think will add value. So that's where the mental clarity really helps. You should know what you want. If you know what you want, then you have a more organized approach. You know, I want to be speaking to these kind of people. Do I know anyone who I know will come on, or do I know anyone who will know someone? So, I mean, if we talk about methods, yes, of course, if you know somebody, then it's better to go, you know, via people itself. But honestly, LinkedIn is a fantastic tool, grossly underrated. I mean, the amount of people that you can connect with, that connections can spring from, you know, jobs, fundraising, everything. I mean, you know, this entire CMU TME network's based on, you know, let's add each other on LinkedIn and come together. I mean, Sanjeev, you've done a fantastic job, obviously, but the possibilities are endless. I mean, Twitter is so active, by the way. You can just reach out to people who are, you know, within the space. I think it's not very relevant to our place. I mean, our region here in the MENA region, but VCs and even like angel investors are so active on Twitter, on LinkedIn. You know, cold outreach helps. You just make a nice formulated message, direct to point. I mean, we know this, you know, being CMU students, you know, especially what helps, you know, having good communication skills. But I think, you know, just make a clear cut cold outreach if you don't know anyone, and, you know, you'll be surprised that people are wanting to help, and they'll be genuinely interested to, you know, at least have a conversation. And, you know, one thing leads to another, and next thing you know, you're sitting on $1 million.
Perfect.
Not all the time though.
Haris, what's your take on that?
Yeah, I mean, yeah, couldn't agree more. I think cold outreach still works as massively underrated because, I mean, I think the reason with cold outreach is because it's been abused by salespeople with horrible messages. So they have like a bad rep towards it.
Yeah.
But one of our biggest investors for Series A came from a cold outreach. I sent him on Twitter. Literally, that's how I got to know him, right?
Awesome.
So exactly, right? So my point is, like, people underestimate cold outreach for sure. Of course, the most renowned method is probably like, you know, like a reference from someone that they know. And the easiest way to get that is actually cold outreaching a founder that they invested in the past. Like, my point is, you'll be surprised how many portfolio companies will happy to help you. Like, you can send an email or cold email to CEOs of so many companies. They will be more than happy to help you, look at your pitch deck, give you feedback. And if they really like you, they will voluntarily connect you with their investors because they know that they will most likely invest. So I think that's a very underrated thing. A lot of people just think like, oh, I have a crazy, amazing idea. It's maybe $1 billion company. Let me go reach out to VCs. And they get like, you know, discouraged because they don't hear back from them, and they'll probably don't. But I think the best way is like, go reach out to the companies those investors have invested in and get those people to vouch for you. Get those people to actually, like, you know, give you feedback. Like, if you're in the early stages, go talk to a company who's just one stage ahead of you so that they can give you feedback that is very relevant to you. So if you're seed stage, go talk to a Series A company. Go talk to their founders or executive teams of that company and get them to review your pitch deck. Go look at your business model. Go look at your pricing strategy and get them to give you feedback and help you improve your business. And then once you're at the stage, they will voluntarily help to connect you with the investors that they are invested in by, right? So there's a lot of indirect ways that people should be actually just reaching out to that. But yeah, reaching out to companies is like the most underrated thing. I think a lot of people should be reaching out to that. And I'm pretty sure me and Sanjeet are more than happy to help anyone on that. So please reach out. Our emails are probably, so Yamna can give it out to anyone. But yeah, happy to help anyone.
For sure. Perfect. Thank you so much, guys. Again, we had a lot of other questions, but any questions that aren't answered and that I can find resources for online, I will be sure to put up all of the resources on Slack. We also have, Saji, if you want to kind of go into it, we have a networking hour after this.
Sure.
So
yes, thank you guys. Yamna, Sanjeet, Haris, absolutely amazing panel. Extremely informative in general about fundraising and great regional context with the family offices and micro investing and whatnot. So if all of you can make it, I've posted the link to the next session where we can actually all see each other, talk to each other. Enough of us are there, we'll go into breakout rooms. And that link's posted on the chat, on the general chat, and in our Slack channel. So see you guys there if you can make it.
Perfect. Thank you
Over
so
and
much.
out. Thank you guys.
Thank you.
Bye-bye.
Bye.